This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, all the way back in our introductory lectures, we said that in relation to either of employment income and or self-employment income, your trading income assessment, that is, that in addition to an income tax charge arising, there was another tax that would be charged in relation to such employment income or trading income of the self-employed. And that is what we see now. Here in Chapter 11, we deal with National Insurance Contributions, or NICs as we'll know them from now on. Now, there are different categories of national insurance contributions, and they go by classes. There are 4 such classes, of which we need to know about 3 of them. First of all, in relation to employment income, as we'll see in Section 1 here, employed earners, we deal with Class 1 contributions. Class 1 contributions cover the 2 players that have a role in terms of employment income, i.e. it's paid both by employers on top of the salary that they pay to their individual. They also have to make a payment of NICs across to HMRC. So employers pay it, as also do employees. You don't have to know the basis of NIC in terms of, so why don't we just have a bigger income tax rate? It goes back to the days when the state benefit scheme started to come in back in the late 1940s there, ostensibly to cover state benefits and to provide funds to go towards the National Health Service. Basically, however, it's just a general tax that fills the government coffers and may be used in any way that it so pleases. What you're going to have to do, however, maybe in a Section A question for a couple of marks or as a part of a Section C written question there, is to calculate, either for employee and or employer, what the Class 1 national insurance contributions may be, or in relation to the self-employed, Class 2 and Class 4. Yeah, we miss out Class 3 there. Class 3 are the so-called voluntary contributions. Now, again, you might think, who'd volunteer to pay these? But there are certain situations in which it might be a good idea, because the ability to have had national insurance contributions over a lifetime of work, whether here employment or indeed self-employment, but specifically in relation to employment here, that constitutes a basis then through the employment income, the national insurance contributions paid down. It gives you a right to certain state benefits, one of which is the state pension. But the ones that we will concern ourselves with here, Class 1 for employee and employer, and thereafter for the self-employed, the unincorporated trader, there will be both Class 2 and Class 4. Firstly then, with our employed earners, Class 1, as we just said, paid both by employees and employers. The Class 1 NIC for the employee is collected at source, as is the income tax. Income tax, you remember, just back in Chapter 9 there, collected through the pay-as-you-earn system, whereby the employer deducted directly at source from your gross salary the amount of income tax that was due. If you were a wage earner each week, more likely a salary earner then each month. We will have, therefore, the responsibility for the collection of the employee NIC and also then the paying over of it and also the employer NICs. The responsibility is there on the employer. So what liability do employees have? Right, in relation to Class 1 employee contributions, sometimes known as primary contributions here, they become payable from when the employee is aged 16 or over. And for our tax year, 21-22, the rate of employee Class 1 NIC is at 12%. Now, that's not an insignificant number, an extra 12% tax charge. But remember, unlike income tax that is liable on the entirety of your taxable income, here the national insurance contributions for Class 1 is only payable in relation to the employment income. It's just on your employment income. So what's it payable on? Well, it's paid where cash earnings. Basically, your salary there, your wage, any bonuses, any commissions that are paid to you. It's cash earnings. It is separate to those taxable benefits that we have. Now, those taxable benefits do not escape the clutches of national insurance contributions, but it's not here Class 1. There's something called Class 1A contributions that pick up on the taxable benefits, but there the liability is purely on the employer. So the employee is only going to be paying Class 1 primary contributions here. The Class 1 employee or primary contribution. And it's on cash earnings, but it's not from the first pound of employment income, only where earnings exceed a threshold of £9,568 per annum. Now again, we're starting to bring in rates and limits here. So don't worry, all of this information is again contained on your rates and allowances page that we'll flick back to in a few moments' time. So you won't have to remember 12%, though I think you will. You don't have to remember 9568. It is a number provided on your rates and allowances information in the exam. Now that 12% payable on the employment income, on your cash earnings that exceed a threshold of 9568 per annum, but that goes, well, not only, but up to an upper limit of £50,270 per annum. Again, another thing that you don't have to memorise, it's given to you on your rates and allowances. And for earnings above £50,270 per annum, it then drops to a rate of 2% being payable. It then comes down to a rate of 2%. And that has no further upper limit. That's on everything else. The contributions will, however, cease when the employee reaches pensionable age. If you go on working after your pensionable age, then it's going to stop at that particular point. There will be no Class 1 employee NIC above your pensionable age. Whereas with employers, the rate of employer Class 1 NIC is a higher figure there, as you can see, 13.8%. Again, payable on the same thing, it's the cash earnings, the salaries, wages, commissions, bonuses, etc. there. But this time, that exceed a threshold of, oops, that's not right, 8788, that's £8,840. Another little typo updating error I've discovered. By the time you're watching this, it will actually say 8840 in your study notes as well. But again, apologies for those of you who've got this first generation of the 21-22 study notes. And that again, per annum there. These are payable from the employee's 16th birthday, so like it was with the employee themselves, but there's no upper age limit. If you carry on working there into your 70s or whatever, then the employer is still going to have a liability in relation to these secondary contributions. Again, as sometimes they're known, employee primary, employer secondary contributions. There's this Class 1A contributions that you may, in addition, have to compute. And the rate of Class 1A NIC, payable, as we said, only by employers on taxable benefits provided to employees, and that rate is 13.8%, i.e. exactly the same as the Class 1 employers NIC rate. And that's applied to the assessable value of those benefits. So for employees and employers there, it's all about Class 1 contributions. The employee will only suffer Class 1 employee stroke primary contributions, whereas we've seen there's nothing up to 9,568, but above that and up to 50,270, it is at the normal standard rate of 12%. Above £50,270, it drops to 2% there. So far as employers are concerned, there's two potential liabilities. Again, Class 1, the other main one here for employers, where we've got a different threshold in relation to when it becomes payable, and that now is £8,840 for the 21-22 tax year. Slightly higher rate, 13.8%, and again, payable in relation to those cash earnings. Class 1A, only payable by the employer there, and on those taxable benefits. So when you see benefits, as we did in Chapter 9, being provided to an employee, those taxable benefits, typically, of course, the company car there was a main one, then the provision of that benefit means that, unfortunately for the employer, they do not escape the payment of NIC. Had they just given more cash to more pay, salary, wage, etc., to the individual to be able to sort themselves out in relation to the use of the car, then the normal Class 1 employer NIC at 13.8 would be payable on such higher figures, increased salary. The situation, however, here is that if you try to say, so as an employer, if I pay them less but provide more benefits to cover the fact, does that mean I could reduce as an employer the NIC liability of the business? The answer is no, because you've still got 13.8% in relation to Class 1A contributions. Now here, be careful when answering an exam question. A Section A objective testing question is the most likely one. But be careful as regards what do they actually ask you for. There's all sorts of possible questions they could pose here. Do they just ask for the Class 1 employee stroke primary contributions? Do they ask for Class 1 NIC contributions? Class 1 is both employee and employer. Or in relation to an employment income package of the employee, do they ask for all of the NICs that would be payable in relation to that employment package? Which means, of course, we've now got not just the employee Class 1, not just the employer Class 1, but we've also got the employer Class 1A national insurance contributions as well on those taxable benefits. So be very careful in the reading of such a question that you make sure you're answering the question that has been posed, because in each of those situations there'll be alternative answers for those who've not read the question carefully enough. So be forewarned, therefore. Now, in relation to the Class 1 employer contributions paid by the employers do, in certain circumstances, get a benefit in relation to the otherwise amount of Class 1 employer contributions that they would have to have paid. It's in the form of an employment allowance. Again, a figure that you won't have to memorise. It's on your rates and allowances page. But HMRC introduced an annual employment allowance of £4,000, as it now is, per employer, not per employee, per employer, to reduce the employer's Class 1 NIC payable. Again, often, again, a sort of pejorative term here, but Class 1 employers' national insurance contributions was seen like a tax on employment, a tax on the fact that you were employing people. Surely employing people as employers would, the clue's in the name, do their businesses would do. This is a good thing. It should be encouraged. And what does the government do? They go and slap an extra charge, 13.8%, on what could be a significant amount of income on the employer. So what they did was to introduce this employment allowance of £4,000 per annum. Now, what that means is that we're going to take away from the overall employer Class 1 NIC liability a figure of up to £4,000. Now, as we'll see here, this amount are able to reduce that employer's Class 1 NIC payable. So if the employer's Class 1 NIC for the tax year is £5,000, the amount payable will be reduced by the £4,000, the full employment allowance being available there, down to only having to pay £1,000. If the total employer's Class 1 NIC was, say, £2,500, and that would be reduced to nil. So up to 4,000, there's nothing going to be payable there. Now, as you can see there, if you are a small business where taking on an extra employee is a very good thing for the economy, because there are so many small businesses, and if all those small businesses could be encouraged, at least in some way through the tax system, to be able to afford to take on an employee, think what that does in relation to the unemployment levels in the economy. It's got to be a good thing. So £4,000, if your Class 1 employer NICs were only £5,000, then £4,000 is a huge reduction, taking out 4 out of 5, 80% of it. If you're a large employer and you're paying not 5,000 but 500,000 or £1 million worth of such NICs, then £4,000 is a drop in the ocean. But that is an important issue in terms of trying to remove what some smaller employers would say is the damage done, and another reason potentially not for taking on an extra employee. That therefore is taken away. So again, a sensible move on the part of the government. But all you've got to remember to do is, if you're looking at an employer, in most situations, there's one exception to this in a moment's time, then you can reduce that Class 1 employer's NIC by £4,000. That employment allowance, however, is not available to companies where a director is the sole employee. Now, this is companies because we're talking about a director here, where a director is the sole employee. Now, the reason for this restriction has been introduced because the employment allowance is targeted at businesses which support employment, rather than an individual who decides to run their own one-man, I shouldn't say that, one-person business here, as a company, with them as the only employee. If that is the situation, you can't here use this employment allowance to reduce what effectively are your NIC liabilities. So it's not applicable to companies where the director is the sole employee. Now, the non-availability of that employment allowance will be particularly relevant in certain tax planning scenarios. Now, again, we mentioned at the very beginning of the course, in terms of our introductory lectures, the way in which, very specifically in Section C, and probably with a 10-mark question involved there, but it could spread wider, we try to, again, have more planning scenarios tested upon us. Again, planning scenarios that may test out more than one just tax. In Section C, we know we're going to be talking about an income tax-based question for 15 marks and a corporate tax-based question for 15 marks. The 10-mark might bring various taxes together, one of which might be national insurance contributions. And one such area is looking at an individual who is in two minds whether or not to actually run their business as a company and become a shareholder, the owner of the company, and then the employee stroke director of that company, or whether to run their business as an unincorporated trade. And one of the taxes that comes into play here, apart from income tax for the unincorporated trade, income tax for the employee of that incorporated trade of that company, as compared to the unincorporated trade, where it's income tax on the trading income of that trader. What we have is a situation where the employment allowance, particularly relevant in certain tax planning scenarios, where an individual is looking at which route do I go down. I'm going to have my own business. Should I run it simply as a sole trader business, an unincorporated trader, or should I run it through the vehicle of a company? So as we say here, when deciding whether a sole trader with no employees should be incorporate their business, this is the situation about the employment allowance, of course, not being available. And then the associated decision whether to extract the company profit, so it's a separate issue. In relation to those national insurance contributions, we know we've got Class 1, primary and secondary employee and employer as regards employees. We've also got the possibility of Class 1A. For the unincorporated trader, we haven't seen them yet, but we've got Class 2, with just a tiny amount per week. And the big one that is similar to the Class 1 equivalent for employees is Class 4 there. And that's going to be linked to the level of trading income. But another issue where national insurance contributions are an issue is if you've got your own company, you're running as a company, then where the director is the sole employee, we've seen you don't get the employment allowance as either director's remuneration upon which NIC is payable, or now, if you've got your own company, what ways can you take money out of your company? They're called owner-managed companies. Owner, you own the shares in the company that then runs the business. Manager, you're the managing director of your company there. You're an employee. So in your capacity as owner, how can you extract from the company the profits made by that company? Well, very simply, as an owner, you own shares. What is payable out of those profits, if you choose to take the money this way, dividends are paid by a company back to the shareholders. Now, when a company pays dividends to the shareholders, the individual who runs this company, they own and run that company, the dividend income isn't employment income. There are no national insurance contributions there. So dividend income would be free of such NIC liabilities there. Whereas in your capacity as manager, the director of the company there, then you pay yourself a salary. And in relation to the salary that you pay yourself, then as an employee, there is Class 1 primary NICs, and as for the company, the employer, there's Class 1 employer NICs, as well, of course, as 1A if there are taxable benefits involved. Now, that issue about what are the tax implications of running a business as unincorporated or running a business as incorporated, and then how do I take my money out of that business in a tax efficient way? In relation to the incorporated trade, I told you, it's you're an owner, you own shares. On shares, dividends are paid by the company to the shareholders, depending, of course, on the level of distributable profits. In capacity as manager, owner, managed company, then you pay yourself a salary, topped up with bonuses or whatever there. In relation to that issue, it's Chapter 26 that is the main one there, Chapter 26, that looks at tax planning scenarios, one of which that has been tested on a reasonably regular basis by the Tax UK examining team, has been that issue about the differences in terms of taxation of running the business as a company, or the more simpler route, taking it as an unincorporated trade. This employment allowance, however, this £4,000 possible reduction, is only available in relation to Class 1 employer contributions and is not available where the director is the sole employee of the company. What do they reduce? They do not reduce the amount of Class 1A, they only reduce the Class 1 employer. Nothing else gets reduced by the employment allowance. Not the Class 1, which of course is also payable by the employer, nor will it serve to reduce the amount of Class 1 employee NIC. It's not going to be available to reduce anything other than the Class 1 employer NIC. If we go now, therefore, to example 1 here, where, again, read the requirements very carefully in such a question, as we've said. Calculate the Class 1 and Class 1A NIC liabilities in respect of this employee. Now, again, it could have said there, simply calculate the total national insurance contributions that will be payable in respect of this employee. that would be the same. Calculate the class 1, that would be the employee and the employer. Calculate all of them, class 1 employee, employer, and then class 1A NIC. It could have just said to calculate the employee class 1 contributions, or just to calculate the employer class 1 NIC, the contributions there. So read that question carefully. First of all, we're told, obviously, an employee for the class 1 to be relevant, paid £60,000 per annum. There's the salary level, 60,000. And was provided with the following taxable benefits during the 21-22 tax year. So what have we got? In relation to that salary figure, we've got class 1. And that is both class 1 employee and employer. In relation to these taxable benefits here, the total of those, we've got the class 1A NIC payable only by the employer. Again, at the normal employer's rate of 13.8%. I said to you that you don't have to remember those rates and allowances. Those are made available to you here. And here we've got class 1 for the employee. As we can see, we've got that initial threshold of 9,568, below which we do not pay, and above which we then start to pay at 12%, but only up to an upper limit of £50,270. Above that and above to whatever level, we drop to a 2% level on that excess. So 12% for anything between 9,569 and 50,270, and above that level, on the excess above that level, we just pay 2%. In relation to the employer contributions, again, sorry about in the study notes there, or the first version of it, it was a different number, the old 2021 level, but for 21-22, we've got a threshold here of £8,840. Again, up to which there are no contributions payable by the employer. But above that figure, and without any further upper limit, just everything above £8,840, we've got 13.8%. But of course, what we will have to go against that, unless it is just the director who is the sole employee of the company, but other than that, we have the employment allowance of £4,000 that goes against the total of all of the national insurance contribution employer class 1 national insurance contribution payments due. That's a total figure deducted from the total class 1 employer NICs. And of course, the class 1A, if as in the example that you're going to have a go at in a moment's time, if there are taxable benefits, and again, we continue with that 13.8% figure, but this time as class 1A. So back to the example. I'd like you to have a go at this, please, if you would be so kind. Work through that one, and I'll join you to discuss and work through, to talk you through anyway, the answer to it. Hopefully by the time you come back to me, you've already done it, worked it, seen the answer, and hopefully gone, tick, that's correct. It's just a computational issue. Pause there for now. Okay, let's see how you fared therefore on that little example. Easiest one to deal with first, I guess, would be the class 1A for the employer, where it's just pick up the taxable benefits. You might there, for example, have to differentiate between those benefits that are taxable and those that are exempt, where you want the taxable benefits upon which this 1A NIC charge will arise. Whatever that total of those taxable benefits comes to, it's a straight 13.8% to give us the amount payable by the employer in relation to, under Class 1A, those taxable benefits. When we look at the Class 1 liabilities, as we are required to do, then firstly for the employee. So far as the employee is concerned, we know we're given an annual salary, and most questions that you get within the Tax UK exam involving NIC calculations work on an annual basis. you were told here, weren't we, about paid £60,000 per annum. You were given an annual salary, and we had to work out the Class 1 and 1A liabilities in relation to the entirety of that tax year. All of that was for 21-22. So what have we got here? We've got up to the first 9,568 is at 0%. Then with a salary, our cash earnings of £60,000, we exceed that upper limit of 50,260. So above 9,568 up to 50,270, we've got the main 12% rate that applies. Again, do check the numbers on that, make sure I've used my calculator correctly. Then on the excess above 50,270 up to the annual salary figure for our tax year of 60,000, then we just take 2%. So far as the employer is concerned, it's actually easier in terms of the calculation because there's only a lower threshold, there isn't an upper limit at which any main rate would cease to be payable. Here we've got up to 8,840 being at 0% before you start to actually pay anything, but then there is no upper limit. So the salary is 60,000, everything above 8,840 is then at 13.8%. So again, work the calculation there. Now say here you were given figures for the full tax year. Sometimes in exam questions, and it often causes trouble unless we mention it now, which hopefully will avert that problem, they may give you the figure for, say, a month or 6 months. Now, what happens in real life is that depending on if, for example, we're a salary earner, as a salary earner, you're going to be paid monthly. As a wage earner, you'd be paid weekly. We won't say any weekly stuff, but on a monthly salary earner basis. Remember we said who is responsible for taking these liabilities away from the employer and for the employer. It's the employer's duty. And the system works in conjunction with the pay-as-you-earn system that applies to the employment income for the income tax deducted at source. So that every week, or for us maybe every month as we might see it, the employer is required to work out on the monthly income what level of income tax under the PAYE system needs to be deducted and then in due course paid over to HMRC, and also what amount of national insurance contributions are payable, both from the employee, from which case that is deducted from their gross salary, along with their PAYE income tax to derive their net income, their net salary there. But the employer is responsible for the calculation of what's the employee and what is the employer NIC figures. And although we don't have to worry about the mechanics of that in terms of any calculations, what you do have to be aware of here, if you were given the monthly income, so a £60,000 salary, that would be what, £5,000 per month, you'd only be asked on this basis for Class 1, not 1A, that's done after the end of the tax year. But for the monthly figure, you're based on 5,000. So what you'd have to do is to take here these annual figures, as we have them, of 9,568 and 50,270, and take 1/12 of that. So we would take 1/12 of 9,568. And for the month up to that level, it would be, well, if I can just, again, get a bit of light on these. So 1/12 of 9,568 would be taken at 0%. So we'd already know what 1/12 of 9,568 would be. So that would go into this calculation. And then 50,270 would again be times 1/12. And you take that as your upper figure. On that difference, therefore, between the 1/12 of 9,568 and the 1/12 of 50,270, you take 12%. Then on the excess of, you'd have £5,000 as your monthly salary. Above that 1/12 of 50,270, that is the calculation there that you do at 2%. So it's a straightforward calculation. We do our apportionment to the nearest month. If it was for 1 month, for the employee that you had to work out what your figures were, you would take 1/12 of each of the lower threshold of 9,568 and your upper limit there of £50,270, as shown there. So far as the employer is concerned, you just need 1/12 of that employer threshold of 8,840. So you time apportion. Are you dealing with a month? In terms of NIC calculations, take 1/12 of those threshold and, where applicable, limit figures. If you're dealing with 6 months, then you take 6/12 of those figures. So we must time portion based on the earnings period, which is, say, for a salary earner, is going to be on a monthly basis. If it's 1 month, 1/12 of those numbers. 6 months, 6/12, 3 months, 3/12, accordingly. Substitute in for the numbers that you've seen in this calculation, therefore. I repeat, for the 1 month figures, gross salary 5,000, you would take 1/12 of 9,568, 1/12 of 50,270, and then, of course, compare 1/12 of 50,270 with whatever the monthly gross salary was there. That being 1/12 of 60 would be £5,000. So far as the employer is concerned, only the threshold to apportion, 1/12 of that. If they gave you 6 months, as I've said, you take 6/12 of those numbers and do the calculations accordingly. So in that way, it is all about computations here. Thankfully, the rates and figures are given to you. Rates and thresholds are given to you on your rates and allowances page. You'll be using that. Don't expect you to remember those odd numbers there. You'll be using it. Just make sure you know how to use it, therefore. Now, that will sort out for us how to deal with Class 1 NICs. Whether we're dealing with employee, whether we're dealing with employer, whether we're dealing with both of them, and if we are dealing with the employer, does the question also require the 1A contributions? That, of course, would only be done on an annual basis. Back to our notes now. Having dealt with the employee, we now deal with the self-employed. And there are 2 types of contribution, only one of which has got any significant level, but there's 2 classes of contribution that we need to be aware of. Class 2 contributions, where it's a flat rate contribution of, the princely sum of £3.05 per week. Again, as with the employee situation, the Class 1 liabilities, it goes from their 16th birthday until they reach pensionable age, when the tax-adjusted trading profit assessed for the tax year exceed a small profits threshold of 6,515. So if your small profits threshold here has not been exceeded, we'd again know what the profit figure was for the year. But if we haven't, then you get away with it. You don't have to pay. You don't pay the £3.05 per week. Class 2 NICs payable under the self-assessment system and will be due on the 31st of January following the tax year, by which date you would, of course, have submitted your income tax computation and you'd know what level of trading income there was and whether or not we had a tax-adjusted trading profit that did or did not exceed that small profits threshold of 6,515. For 21-22, therefore, it will be due on the 31st of January 23, the 31st of January, following the end of the tax year of assessment. The much more important one, and by far the greater figure, the Class 4 contributions. They self-employed pay these Class 4 contributions, which are based, of course, on our assessable, our adjusted trading profits of the tax year. Whatever we found in our working back in Chapter 4 and Chapter 5, whatever we established as the tax-adjusted trading profit of the accounting period, then in relation to the tax year for which it is assessed, we will have our assessment being the rate of Class 4 NIC is nil up to 9,568 there. So as with the employee for employment income, we have a threshold below which it is not payable, above which it is payable. of £9,568. This time, however, for the self-employed, look, we get a lower figure. It was 12% on such income there, employment income for the employee. In relation to the trading income, we're talking about a lower figure of 9%, and is payable on trading income between, well, above 9,568, so between 9,569, and again, that same upper limit as we employ for the Class 1 employee contributions there, above which we pay at a lower rate. So we've got the self-same 50,270. Above that, again, a set rate of 2% is payable on any and all remaining trading income in excess of that upper limit. Here, we don't do monthly apportionments. Again, if it's a normal continuing business, there isn't an issue. You've got an accounting year end that gives you the trading income. But if it was the first tax year, or maybe even the final tax year, that may be other than a 12-month period of profit that we're dealing with. It doesn't make any difference. Whatever is the trading income assessment for the tax year, however long the trading income period may have been, we use these numbers, the 9,568 and the 50,270 there, to know where do we pay 9%, where do we pay 2%. Again, from an admin point of view, contributions begin if the employee is 16 at the start of the relevant tax year. Don't see this as being an issue, in all honesty, for you in the exam. But contributions cease when the taxpayer reaches pensionable age, again, at the start of the relevant tax year. Example 2, trading profit assessment, 21-22, £60,000. What have we got to do? We know to read the requirements carefully. It might just have said calculate the Class 4 NIC, and that's part of what we do indeed have to compute here. And it also says the Class 2 NIC. Now again, if it is 52 weeks worth, a full year's worth of trading that we've done in terms of our basis period, then we're talking about £3.05 per week. So on an annual basis, 52 times that number. The Class 4 NIC, of course, based on the 60,000 trading income assessment, up to the threshold of 9,568, there's nothing. Between that threshold and the upper limit, the limit there of £50,270, then we've got the main rate at 9%, and on the excess we have 2%. So get your calculators out therefore, have a go at that, then come back and we'll have a quick look through that answer together, just to make sure there were no problems on it. Pause therefore now. Okay, hopefully no problems on our calculations. As we said, the Class 2, as it's 52 weeks worth, a full year's worth of trading, £3.05, 52 weeks, and that, hopefully to the nearest pound anyway, is about £159. In terms of Class 4, that's where the big numbers arise. We'll be looking at only payable at 9% on the difference between that threshold of 9,568 and up to that limit of 50,270, as we said, at 9%. Above the 50,270, up to whatever that trading income assessment was, that's at 2%. Hopefully those calculations are correct. Put them together, and all being well, we get £3,858. Again, make sure that you are familiar with the computations that need to be done. Know that all those limits, thresholds, rates are given on your rates and allowances tables, so you don't have to memorize them. And also remember, when you do a question, read that requirement carefully. Are we looking for all possible liabilities there? Are we only looking for some? In the worst case scenario, we might get a situation where you have a combination, a possibility of someone was an employee and partway through the tax year gave up employment, started self-employment. And that would be a situation if it was, say, halfway through the tax year when the employment was given up. In relation to your Class 1 NICs, you'd have to take 6/12 of the threshold and limit figures there in terms of then computing the amount of NIC that would be due for the part of the tax year for which the individual was an employee. For the rest of the tax year, in relation to having traded there, we need to know what was the trading income assessment in what was the individual's first tax year of trading. Whatever that assessment was, use the full figures as we have here, the 9568, the 50,270, no time apportioning there, no 6 months thereof because we only traded for 6 months, no. For the tax year, what is the trading income assessment, and compare with that threshold and that upper limit of 50,270. Okay. That now means that having spent the vast majority of our time dealing with income tax, but now seeing that on employment income and or trading income there would be a further taxation charge in terms of national insurance contributions, we now move to the next of our personal taxes, those that impact upon the person, on the individual, and that is to look at capital gains tax. In essence, a very straightforward idea. We manage to sell an asset. It has to be, as we'll see in the next lecture, a chargeable asset. We sell it for more than we paid for it. And the difference between your proceeds and your costs is your capital gain. Then, like with income, do we have to pay tax on all of that gain? Or like with income, do we get the equivalent of a personal allowance? And we do. It's something called an annual exempt amount. It's the same idea as the personal allowance. Every one of us has got a level of gains that we can make each year that will be covered by the annual exempt amount and therefore be exempted. Then above that, what are the tax rates that apply? And that's where, as you will see in the coming lectures on chapter 12, is where it gets more interesting, because the rate of taxation will be linked to two things. The type of asset that the gain that we have made has actually been, what type of asset was it, and also then what level of taxpayer back to your income tax computation and your taxable income figure of that computation, what level of taxable income did we have? Inasmuch as, are we already a higher rate taxpayer because that gives rise to one set of CGT rates, or were we off the income tax computation merely a basic rate taxpayer? In which case, however much of that basic rate band may then be available to you that hasn't been used up in the income tax computation, that then will be used to tax the first part of any taxable gains. And anything that falls into that basic rate band that remains, that's going to be at a lower rate, a lower CGT rate than if you were a higher rate taxpayer. But all of that, the basis of computing gains and how then we proceed to tax it, well, that awaits us in our coming sessions together.